Hi everyone, and welcome back to Behind the Numbers. I'm Dave Bookbinder, Senior Director at CFGI. This is the program where we dig deeper to understand what matters most in business. As always, I'd like to invite you to connect with me on LinkedIn, Facebook, and Twitter. Today, I'm excited to have a good friend who's a guest on our program. He's a former CEO, currently the managing partner at MSI Capital Partners. I'm talking about Bill Wilkins. Bill, welcome to Behind the Numbers.
Well, hi, Dave. Thanks for the invite. It's been a while, so it's good to see you.
Likewise, thanks for joining us. Why don't you tell the audience a little bit about yourself and about MSI Capital Partners, Bill?
Yeah, gladly. I'm happy to. And from a Zoom perspective, these applications are extremely helpful during these kind of COVID-related things. So it means that business can actually get done. But MSI Capital Partners, we are an operationally focused private investment firm headquartered in the Philly area. We make control investments in North American-based industrial businesses serving both domestic and global markets. And I'm the founder, but myself and the rest of my partners, we're all former senior executives, mostly CEOs, with extensive domestic and international leadership experience. And we seek to invest in small to mid-sized manufacturing companies and industrial service-related businesses, particularly where our many decades of industry knowledge and expertise can be utilized essentially to achieve higher than average returns. So when you think of it from a metric standpoint, we will look for platform companies with sales revenues with sales as small as 10 million up to about 100 million. And from a profitability standpoint, we generally look for businesses that have profit as measured in EBITDA between 3 to 15 million. The other point that we would make is that when we make an initial investment in a company, our desire is to invest in companies that are headquartered in North America, although we are willing to make follow-on investments internationally as the business grows. So that's MSI, Dave.
I appreciate that. You mentioned that, well, obviously yourself and your partners are former executives. How has that impacted what you do day to day, and does it give you a competitive advantage? And just from the lens of having been in the seat of the business owner, how's that impact what you're doing, Bill?
Well, it's certainly helpful, and what it does, it differentiates us from other investment firms in that we have walked in the shoes of the owners, or the leadership team. So stylistically, we recognize that in order to move the needle in a company, change is going to have to come by operational improvements, operational efficiencies, changes in profitability, as opposed to the usual, or what was the usual approach to leverage buyouts, where shareholder gains were made through financial engineering. So we have the wherewithal, since most of us have been in the saddle for over 35 years. Our approach is one more of mentoring and coaching, which I think is the winning combination to be able to pull together the management team and ultimately transform the culture and move the business forward.
Yeah, I'd like to unpack some of what you just said there, because it was interesting and unique at the same time here. A coaching perspective and a culture. Can you elaborate on both of those points, Bill, and how you tease those kinds of things out of the leadership team and what the impact is?
Well, what we attempt to do, again, from a coaching standpoint, it's all too easy to run a company from the board level, and think that you're having an impact by just showing up at quarterly meetings. What we do when we acquire a company is we are essentially on the ground from anywhere from 6 months to potentially 18 months, pretty much on a full-time basis, where we're working alongside the management team. And what it really comes, where it really starts is the development of what we view as being an executable strategy. And it's one that we develop not in a vacuum, but we develop with the management team. And we basically help them execute the plan. And when it comes down to being a CEO, more often than not, that particular role, given all the complexities associated with it and the number of constituents needing to be satisfied, it can oftentimes be the loneliest damn place in the world. As you're kind of sitting there thinking, well, what do we do next? But we are able to bridge that by bringing hands-on experience and being advisors, if you will, to the president or the CEO of a company, and also one layer down with the management team. To answer your second part relative to culture, we generally like to think of our process as we go through due diligence and acquiring a company. We spend a good deal of time evaluating the management team, and it generally revolves around transformation, or the ability to do not necessarily more with less, but to be able to accelerate the growth of a company or the trajectory of a company. And it really starts out with asking three questions. Are you willing to listen? Are you willing to learn? And thirdly, are you willing to change? And the third piece is the most difficult. Although there's generally a willingness to be able to want to change, the ability to change and move to a higher level of performance oftentimes can be pretty elusive. So that comes back to the mentoring relative to helping the team be able to reach levels of performance that they never believed they could achieve.
Yeah, how often do you get 3 yeses there, or how often do you actually see the yeses get executed in practicality? Because you probably get the yeses, but then when you start to get into the hard work of actually doing it, it may change.
It generally does, but for the most part, as part of our evaluation in due diligence, we can read balance sheets and P&Ls with the best of them, but making a bet on an acquisition, Dave, it really is about the people. You're investing in people and their ability to be able to do better, execute well. And so yeah, it's getting to the 3 yeses oftentimes is hard, and I would be untruthful if I said to you that we have never changed members of a management team. We do that relatively frequently, but that in of itself is a process, and we give all the tools that we can to help people be successful. So it's not through the lack of trying.
Yeah, and that message about it's the people has a particular resonance with yours truly here. But for those watching and listening, depending on where you get your data, up to potentially 90% of merger and acquisition transactions fail to deliver on the synergies that are proposed in the deal. And the main reason for that failure to deliver the synergies is the people equation. It's the integration of culture. So spot on, Bill. I want to shift gears for just a little bit here into kind of the investor mindset. A lot of times investors may be reluctant to sell their business, and they're often looking for what we like to call the second bite of the apple. Is that something that you can help them achieve?
Uh, yes, I mean the approach that we take is designed for entrepreneurs, owners of businesses to have a second bite of the apple. More often than not, when a business is for sale, whether it come through the usual channels of investment bankers, or as we like to do, develop our own deal flow. More often than not, the discussions with owners really revolve around they've reached a crossroads, and reaching that crossroads could be through a realization that they can't or don't have the wherewithal to be able to take the business any further than they have. Secondly, there potentially aren't successors, whether they're members of family or whomever, to be able to take over that business in a reasonable transition. And then thirdly, owners may be staring down the barrels of, a singular asset, which is between them and retirement. And so the risk of having, for want of a better expression, having, all of your eggs in one basket become, a lot more profound. So what we, generally try to do is to engage the owner relative to figuring out, do they have an appetite to continue running the company, or do they wish to stay on in some other capacity, whether it be board or advisor related, which is something that we encourage. And then secondly, the ability to roll over a piece of equity into a minority position in what we would characterize as NewCo. So that's kind of the second bite of the apple that we try to encourage. What it does also, it's an incentive for owners to continue to be on their game, and also to recognize that the bill of goods that they're selling has to be what we think we're buying at the same time, simply because they have skin in the game post-transaction.
Yeah, Bill, we're going to have to take a quick break here, but before we do, can you just tell the audience quickly how they can contact you if they want to learn more or work with you?
Oh, sure. My email address is my last name, Wilkins, Wilkins, at mgmtserv.com, or go to MSI's website, which is www.mgmtserv.com.
Great. Thanks, Bill. On that note, we're going to take a quick break here. Don't go anywhere. We'll be right back after a quick break.
Shemtab Dragonovsky Taylor will help you move through and beyond your divorce. We are a full-service boutique family law firm located in Blue Bell, Pennsylvania. We handle cases in Montgomery County, Chester, Bucks, Delaware, and Philadelphia counties. We have 6 highly experienced lawyers and have represented clients for more than 30 years regarding these issues. Our clients depend on us to sort through the complicated issues involved in divorce and division of assets, spousal and child support, and custody. We listen to them, we gather the information, and we help them make informed decisions. We pride ourselves in our knowledge and our experience. We try to settle cases when we can, but we zealously advocate for our clients at trial as experienced and successful litigators. If you need help on any of these family life issues, please call us for an appointment at 215-542-2105 or check us out on our website at www.shemtablaw.com.
Hey there, welcome back to Behind the Numbers. I'm Dave Bookbinder, and today we're talking with Bill Wilkins, who's the managing partner at MSI Capital Partners. Bill, I want to start this next segment here with one of the topics that's near and dear to my heart, which is valuation. So a couple of things here with regarding valuation. When we were doing our prep conversation, you used the expression bridging the chasm. I'd like you to share that and explain that to the audience, what that means.
Oh, okay. So what we're referring to there is trying to find common ground, where there are expectations that could potentially torpedo, a deal at the best of times. So what I mean by that is, we value a business, based, it's kind of earnings based, and then we think about valuation from a cash-free, kind of debt-free kind of perspective. The more often than not, sellers are very much in tune with their own business, but are unable at times to take a very dispassionate point of view on valuation. So they are high essentially, and we're somewhere lower generally, and the chasm is the thing in between. So the next question, I guess, would be, how do we bridge that chasm? And that would be in the form of an earn-out. So we try to make sure that the seller understands that it's a not necessarily an all cash transaction, in the sense that there may be a delay in in receiving the full value of the business, because we want to reward the seller at a future point in time, provided that the company continues to perform at agreed levels, and that measurement happens at agreed to milestones.
Yeah, so that keeps the leadership team fully engaged, fully invested in the business, driving towards those financial performance goals. And it could, in some instances, the way the terms may get structured, result in, at the end of the day, a larger valuation than what otherwise may have been negotiated up front. Is that fair?
Yes, it is. And what we attempt to do at all times is to be unscrupulously fair. So when we look at kind of the post-transaction period, that in of itself is the most critical part. And some folks talk about the 100-day plan. Well, we look at least 180 days in terms of looking at a playbook as to who's on first, who does what, and it gets pretty detailed. Unless we have the management team, which could ultimately be the owners as well, unless they're glued into place and suitably motivated, then it's going to be difficult to be able to get a good start to the to the NewCo coming into being.
Yeah, you mentioned that from a valuation perspective, you use something called EBITDA, and I think everybody pretty much knows what that is, but earnings before interest, taxes, depreciation, and amortization. But there's also a new letter being tacked on to the end of EBITDA. That's a C, EBITDAC, where the C is coronavirus. Talk to us about what your experience is. What are you seeing right now, Bill, with regard to coronavirus adjustments to EBITDA, or this new EBITDAC?
Yeah, it's a source of irritation for us in particular. We generally like to do valuations on businesses, or perform valuations on business relative to what you see is what you get. And so when a business is looking to make judicious adjustments to earnings, saying, well, it would have been this, had the market not responded or closed down for 6 months. This is where we would have been. We're empathetic to that for sure, but it's difficult to place a valuation on something that isn't real. So I think that investment bankers are contribute to some degree to the problem, but on the other hand, investment bankers also bring reality to to a seller at the same time. So hopefully, if there are adjustments, they're relatively small. For instance, in terms of the PPP loans that companies have been able to get from the Small Business Administration, the SBA. How are they handled? Or is there visibility to what the impact is, both on the income statement and the balance sheet? Those things need to be very visible, and they need to be disclosed. So, I don't wish to make the investment bankers out to be the bad guys. Far from it. They're the good guys. But the bridge for earnings is the thing that is the most tricky. And we take a position which essentially says, okay, we will provide some level of understanding and mitigation, for the COVID period, but a business needs to stand on its own. So if we find ourselves with a chasm on valuation, our perspective is, well, if you do not wish to, agree to the valuation we place on the business, then, kindly run it yourself with the risk, manage through this period of time, which we recognize can be difficult, and we'd be glad to talk to you at some point when you're ready to sell. So we tend to push back on that, Dave.
Yeah. And look, normalizing and non-recurring adjustments are normal in valuation from a historic financial statement perspective, but most evaluation's forward-looking. So when you think about the forecast that you're seeing right now, what kind of visibility do people really have into the future of the business in this environment?
Well, it really depends, and that's the word. It depends, I guess. Of course. But it really depends on the degree to which the company or a company is purely book and bill, or whether or not they have backlog. If a business has backlog, and you're able to see trends, whether it be downward, upward, or flat, and the fact that backlog has been executed on. You may find yourself in a situation, particularly with businesses that are, that have long-term agreements, Department of Defense kinds of businesses, aerospace kinds of businesses, for example. They may have, 12 to 18 months, window into, what's coming. Now, it doesn't mean that the customer could cancel orders, for example. That happens quite frequently. But those that are book to bill, or book and ship, I should say, having visibility beyond probably 6 to 12 weeks can be tough, and that's where you need to really look at shipping trends historically. In order to be able to understand the seasonality and also cyclicality of a business at the same time as you're trying to make some of these judgments. And that holds true, particularly when you're valuing a business, kind of taking really two stakes in the ground, saying, we recognize, subject to quality of earnings, that your business operated at this level during the last 12 months. So you're looking at TTM or trailing 12 months. But we're saying, okay, we'll pay you this based on the forecast for the balance of the year. And that could mean that there's 3 months left for the rest of the year, or maybe even 6 months. And that's where reality sets in. And for the most part, we have been using earnouts more frequently in the last 9 months than we have in many, many years.
Yeah, way too much uncertainty these days, as always, but even more so now. Bill, how can folks reach out to you if they want to have a conversation?
Well, as I've mentioned, the best way to reach me is via my email, which is my last name Wilkins, Wilkins, at mgmtserv.com. That's my email, or via the MSI website, which I invite you to go take a look at, which is www.mgmtserv.com. And you can leave me a message there, and I'll get back to you promptly.
Great. Bill, I think we've got about 90 seconds to go in the program, but I want to try and sneak one more thing in for you. If you could perhaps share from your experience kind of a best practice, tip, advice, trick, if you will, for the folks who are watching and listening who want to learn what are the things that you see that sellers, business owners are doing wrong that you have to come in and fix, so maybe they can start working on that today?
Really a couple of things. One is timeliness of reporting, actual results. So management teams can't wait for 6 weeks until they know what's happening with the P&L. That is something that we bring in, immediately. The other piece is it requires good skill and good expertise relative to being able to see around corners or forecasting, and weaving into that not only forecasting, sales for the business in terms of the direction the company's heading, but also on a cash flow point of view. So, we would be, very remiss if we didn't bring in, 13-week rolling cash forecasts to run or manage treasury-related activities, but also sales forecasting, being able to look at several months, if not the balance of a year, to be able to really understand where the company is heading, and then also how to make course corrections if we see issues. So those two things, I think, are very fundamental building blocks.
Great. Thank you for sharing that, Bill. And thank you so much for joining us today on Behind the Numbers. It was great having you.
My pleasure. Thank you, Dave.
Great. And for you watching and listening at home or in your car, wherever you may be, thank you for joining us as well. We really appreciate your support. Please be sure to subscribe, leave a review, leave a comment, reach out, let us know what you're thinking, and stay in touch with what we're up to here. I'm Dave Bookbinder. We'll see you next time on Behind the Numbers. Take care, everybody.